Welcome back to the Everything Property Podcast. Today's guest is no stranger to the podcast. He's been on many times before. He's on today to break down a very interesting territory to have a look at. Mat Djolic, welcome to the Everything Property Podcast.
Thanks, man. Thanks for inviting me again. It's sort of been a while. We're both busy, but I'm really happy to be here again, man.
I mean, as per the brief, I'm seeing Darwin pop up. I haven't seen it pop up in terms of for an investor for a very long time. Obviously, it's coming back up. I see it's popular on socials, see it's popular on YouTube.
Yeah.
Thought what would be good to get the data expert, the man himself on, just to run through what you're seeing in Darwin at the moment. Is there activity? Is it going to be a spot where a spot where us investors can look into? Is there longevity in that market? What areas do we like the look of and that kind of stuff? So, mate, if you could, I'd love to dig into it.
Yeah, no worries. I'll start with a bit of a story, okay? So, as you know, in Mastermind, we teach a particular methodology when it comes to predicting market movements. And I think for about now, I might tell a lie, but over 6 months, I have been doing shortlisting and detailed comparisons for a particular price point. And I think the price point is, I think, 450 to 650, And some of the Darwin areas kept on popping up. And what's funny is that I always say to people, do not use bias when you're assessing areas. Don't use your personal bias about any area. Just look at what the data says. And the Darwin area used to be minimum in the top 3, always, if not first, for the last 6 months. And I was putting it aside. So every time I spoke to a client, I said, no, I don't know, it's Darwin, just put it aside. And I was ignoring it, So essentially, I suffered the curse of bias in the same way that I tell my, members not to do it, And I know I owned up to it, and I put a post in Mastermind and all of that stuff, which just reinforms that you really should just look at data and analyze it. Well, not just, but you need to, follow those trends. So what is interesting about it is that it has been popping up in the last 6 to 8 months. But Darwin in general, if I have to say or comment about it, I see a lot of people buying in Darwin at the moment. And most of the areas that I do see are areas that I wouldn't touch.
Wow.
It's areas that I wouldn't invest into. So Darwin has some great opportunities because it is extremely affordable, and the socioeconomic composition of Darwin, especially some areas, is extremely high or affluent. So what you are fronted with is a combination of, properties as cheap as chips, and I have a lot of dry powder sitting on the sidelines, essentially. And if the yields are extremely high, which they are, extremely high, relatively high to other areas, usually the relationship between yield and growth is that when rents increase to a particular point where it becomes more meaningful to buy, you have a shift from rental properties towards ownership, demand for rentals towards ownership. It does provide some great opportunities, but as I said again, I think I want to preface that with saying that I do not think that buyers should be rushing into every area in Darwin. In the same way that not every LGA grows at the same pace, therefore not every suburb grows at the same pace in Darwin as well, and you should be careful about it.
Okay. So it's interesting, as we were talking about offline though, and as you said, there's plenty of areas that you've seen and heard people buying in that you wouldn't touch.
Yeah.
So I want to, as we usually do in the H-tag and the methodology, is strip it all the way back. Let's go to, start with the most basic filters to see, what data we're picking up there, what confidence that we have in that Darwin market, because automatically it's pretty slim pickings from the start, right?
Yeah, absolutely. Now, before I start, I just want to say something, and I think I did what I always tell people not to do. So I said I wouldn't touch an area. Now, when it comes to wouldn't touch an area, you need to have a clear understanding of what you're trying to achieve. I wouldn't touch an area that's not going to give me 30% growth in 2 years if I need 30% growth in 2 years, for example. Or I wouldn't touch an area, invest in an area long term if that area doesn't have long-term stability and lack of volatility signs, So in that respect, some areas in Darwin will not provide for, I guess, short-term returns, but also have a huge question mark against, long-term volatility or, lack of stability, essentially. So going back to the filters, I'll look at 2 different areas. So I'll look at Darwin, a GCC, Greater Capital City Region, and I'll look at Municipality Darwin, which is an LGA. So I just want to look at both areas just to see what we get. So I'm not even going to set the price filter. Okay, I'm going to say for any price point. And for example, the first thing that I always do is always say is that you have to account for data confidence. Data confidence is important because confidence speaks about volume. And volume of sales, you need a sufficient volume of sales in order to extrapolate a discernible pattern from which you can make a decision. If I'm looking at a data set and I want to make a decision upon that, I have to be sure that what I'm looking at actually is stable.
Yeah.
Stable enough. So high data confidence is very important. As soon as I set it at high, for example, I only get 10 suburbs. Okay, if I take that out, if I take the confidence out altogether, so we get 42 entries.
Okay. Wow, 25%,
within the GCC. So what I'll do, I'll add the confidence back in. Okay, equals high. Now, as most of the people know who are in Mastermind, as you alluded to as well, there is a layering methodology to things. Now, again, it has to relate back to your brief, the answers to the 4 questions. What is your budget, investment time horizon, equity extraction time frame, and risk profile? And that inadvertently will correspond to how you layer metrics. Now, I've just included 1 metric and I'm already at 10 entries. So just imagine if I started adding more conditions to fit a particular strategy where we're going to get to. Yeah. So the next thing, for example, that you should do, especially if your investment time horizon is long-term, is you should address the risk score of the area, the RCS risk score. Why? Risk score is a proxy of volatility. To explain, so if you have a centralized industry, for example, and by the way, different people quantify risk in different ways. I quantify risk, or a H-tag will quantify risk as anything that will stop you from achieving your goals, whether it's capital growth or cash flow. Property investment is a deterministic game. It's one of the two, or a mixture of both, So anything that will stop you generating those returns is essentially a risk. And so there's economic risk and environmental risk. Economic risk would be industry centralization, dominance of mining and agriculture. Environmental risk would be flooding and bushfires, And then you have some suburb risks such as low hold periods, high rent to owner ratios, etc. So what I always do for long-term investment time horizons is I insert the RCS risk score, which accounts for those items that I've mentioned, and I set it at greater than equal to 50. Why do I do that? I do that to eliminate areas that have higher than average inherent risk because they're usually going to be more volatile, okay?
Yep.
When I say volatile, consider volatility in the context of reduced annual...
Up and down,
of reduced annual averages. So your compounding averages are going to be lower if it goes up and down.
Yep.
Think about it that way.
Yeah. So one year you might have minus 20, plus
Correct.
20. It's just not a market
you're going to end up at 0 at the end if it's too volatile.
Yeah,
so that's
100%.
your average, So if I set it at 50, what do we get? We get 2 areas. So that's filter number 2. Okay?
That's not good.
Okay, what is filter number 3?
So we have, for anyone that's listening to this audio and not visually, we have Durack, Northern Territory, and we have Humpty Doo, Northern Territory. So they're the 2 that we're down to.
Which means that essentially all of the suburbs so we went from, 44 without accounting for confidence.
Yeah.
When we accounted for confidence, we got 10. And then we introduced the risk score and we got 2, which means that from 10 to 2, the reason why all the other ones were eliminated is because most of those suburbs have centralized industries or, exposure to some negative environmental effects. And we can inspect it further, but just for the sake of the podcast, let's say that they have risk in them, So now, if your investment time horizon is long-term, that is a huge concern. Now, if it's short-term, you can be more relaxed with risk. But again, that's what I'm trying to say. If you're promoting Darwin online, promote Darwin in the context of a particular brief. Darwin is a great investment opportunity. Darwin is a great investment opportunity for such and such brief. And then we can say, yes, no, maybe, not just say Darwin is great. So that's why I want to really emphasize so people are cautious about jumping in.
Yeah, people miss that, man, a lot.
Yeah.
They always say like Darwin, but they don't address. That's our issue with hotspots.
Correct.
They always
Same
say
thing with birth.
For what brief?
Yeah, exactly. So the third thing that I always do, and listeners should know that it's probably the mega metric. It's the affordability. Okay, so purchasing patterns are driven by affordability. Simple as that. That should be common sense. So if the wage growth and property price growth, or the gap, has been the widest since 1970, so how many decades now, and not widest, like it's a Grand Canyon, essentially, That means that only the suburbs that are affordable will see participation from owner-occupiers and investors, okay? Especially from owner-occupiers who are the 2 times larger buying cohort.
Yep.
So you should satisfy the owner-occupiers. So if I set the affordability index, let's go. I'm not including, so because I haven't set the budget, affordability index responds to the budget, and those who, learn our methodology understand different segments, but just for listeners, if I don't set the budget, let me just explain. So 550 and below, the index should be about 35 years to own. Between 550 and 850K, typical price, it should be about 40 years to own or less, okay? And for 850 and above, it should be 45 years to own or less, okay?
Yep.
It's essentially a friction point or mortgage stress indicator. Now, because we don't have a budget, I'll set it at, a high 40, They're still there. Good.
Okay.
We've still got 2 contenders, okay? Now, let's move into, the next thing that we have to do, especially for higher price points, we have to account for socioeconomics. I did research, 0.34% chance that an area that's 700K in typical value will double in a decade with a socioeconomic index of 1 or 2, which is disadvantageous. There's virtually no chance.
Or at what price range, sorry?
700K.
And above.
700K and above.
Okay.
So there's virtually close to 0 chance.
But once that comes down, that increases, yeah?
So once the price comes down.
Yeah.
So for price points that are 550 and below, socioeconomics don't play a dominant role in long-term growth. Mm-hmm. So you have a lot of areas that have an index of 1 and 2. By the way, if you're investing in 550 and below, you're bound to invest in an area that's socioeconomically disadvantaged.
Makes
exactly.
Sense.
So for those price points, no. For price points above that, in order to have that long-term steam and participation and purchasing power, you need to have high socioeconomics. So let's look at the ERSAT and set it at greater than or equal to 3. Why 3? So ERSAT is a score from 1 to 10. Disadvantaged areas have a score 1 and 2. Neutral is 3 to 8. Opportunistic is 9 and 10. Mm-hmm. Now, I'm not being even too rigid on the filters, yeah? I'm just setting it at the bottom range that I wouldn't compromise on. So I'm not including disadvantageous areas.
Yep.
I'm not going and setting it at 10 here, We still have contenders in here. Okay, next thing that I always do, as you know, I restrict the supply. Now I'll speed this up just so people don't have to wait too much. But essentially, you restrict the supply initially because you don't control the supply, government does. So you first address the things that you don't control. Mm-hmm. You and I, let's say, community, everything property community, you go, guys, let's all go and buy in Ballarat. Hashtag community, let's all go buy in Ballarat. We control the demand side of the equation. We manufacture growth that way. Yep. However, when you're manufacturing growth way...
It sounds familiar.
It's superficial. It's superficial, doesn't last a long time, okay? And it's essentially what I call speculation. However, even if you manipulate the demand side of the equation, you still can't see any growth if the supply is rampant.
Yeah, okay.
Yeah?
Yep.
So we address the supply side of the equation. I'll be quick now.
That's all right. So after you've put in that ERSAT, the 2 options are still available, Durack and Humpty Doo.
Correct. They're still there. They're hanging on by a thread. Let's see. Well, not a thread, but so I'm restricting the trends in supply as well. I'm restricting the trends in the absorption rate for those who are listening as well, which is what referred to as inventory. I'm also restricting future supply of new dwellings by addressing the building approval ratio. And this is especially important for those who are aiming for short-term equity extraction timeframes. You don't want an influx of, building approvals coming to the market where you want to leverage into additional purchases.
This is true.
And then hold periods, okay? See, less than 1.5 building approvals. Yeah. If I set it less than 1.5, we got no results. Okay, so why 1.5%? Now, there are ranges in building approvals: opportunistic, neutral, and unfavorable. Okay, 1.5 is in that middle range, but you can play with it a bit more, and let's give it 2%. Okay, still nothing there.
Okay.
2.5. Sorry, so if I give it a 2, I think it's going to show up. There's a lag. Okay. Now, hold period is important. Why hold period is important? Long-term future supply, livability factor, all of these other things. Let's look at the hold periods. Hold periods are usually set at greater than or equal to 7, at least one bottom end of one property cycle. Okay, so this is why I'm saying, out of entire I would say, Darwin GCC, that are essentially only two areas that stack up on about 70% of indicators that I need personally in order to make a call on a particular suburb. Okay?
Wow.
Now, out of those two, Durack is better. Reason being is because Humpty Doo has...
What a name for a suburb.
Humpty Doo, and we'll go into it. I'll show you what I mean. Humpty Doo has currently very high 3-month rolling averages for building for days on market. Okay, why is that important? So I'll go into all of the metrics. Let me just expand a few things that's important. Affordability index. Okay, so see Humpty Doo, if we look at the supply side of the equation, it is great. You have a nosediving long-term stock on market. You have a nosediving short-term stock on market, which means supply scarcity will continue into the future. Interestingly enough, there's only one listing. Okay.
Wow.
Okay, so we have inventory, the absorption rate improving as well. Building approvals are dropping, currently sitting at 8 approvals. Nothing dramatic. Okay, no concern there. Hold periods are at 8 years at the moment. The line. Good. So it's pretty good. It's great. Now, for us to see capital growth, okay, we can't just have supply scarcity. We need to have improving demand, and we need to address the demand side of the equation. Now, what do we see? We see 3-month rolling averages for days on market being 91 days, which is unfavorable, okay?
That's
now,
huge.
Not only that, the long-term slope for days on market is flat. The short-term slope for days on market is increasing, which means that demand is weakening. When you see an increase in days on market, that means that demand is weaker. So, yes, supply scarcity is substantial, but the demand side of the equation is weakening. So you might see growth because if I look at the left-hand side at supply scarcity, the trends are much more severe in a sense that supply is,
But would you say that days on market has increased because there's literally no stock on the market?
No. Good question. So
because stock on the market, it's only one listing, and I'm looking at
but then it would be 0.
No, but what would the days on market show then?
Yeah, so the days on market, if there's one listing, so there's one current listing, yeah?
Yeah, so what if that's like there's only one listing, it's the ugly duckling that's just online and everyone's like, oh fuck, just leave it alone.
That's fine, it will be an outlier. But then if you look at the days on market across multiple timeframes, which you can see across many months, so this is one listing for the current month, yeah?
Okay.
Yeah?
Yep.
But look at across multiple, and even if it's one listing, by the way, okay, even if there's not enough listings, okay, and that's why they're sitting high, the volumes of purchasing are reducing, which means that this area might soon enough be pushed into the median confidence data set.
Yeah.
Know? Yep. So there's no churn happening. I can't see a pattern. Okay. So I like the supply side of the equation. It's great. It's phenomenal, but I'm concerned about demand. So would I invest in this area? We need to inspect it further, look at the long-term indicators. I love the fact that socioeconomic is great, sitting at a 7.
Wow.
I love the fact that it's extremely affordable. Its affordability index is sitting at 25 years to own. And just for listeners, usually for price points that are 685, the affordability index sits at around 35 usually for preferred areas. Wow. This is 25. So it takes, what does that mean? It means that in this area, people pay off their house 10 years sooner than in other areas, yeah? So overall, rent-to-owner ratio is good. I'm concerned about its longevity because of the GRC. We can see that it spent only 53 months in the last 2 decades above the positive growth line. And if we go back to the typical price, we see how it's been stagnating for X amount of years, okay? We see growth in 10 years only being 5%. Now, that doesn't mean that it will not grow in the future, but what I'm saying is that I'm questioning its long-term potential. So when it comes to comparison or choosing the West Suburb, you pointed out, okay, maybe the days on market, is higher because there's not many listings, okay? Then the counter argument to that would be, well, if it's higher all in the last 6 months to a year, then it's just not only that, it's something else, okay? And it's a concern on demand side. Plus, long-term potential is weaker here. If the property, put it this way, when your days on market are higher, and let's say it's the ugly duckling in the last month, but it can't be the ugly duckling month before that, or month before that, a month before that, for the entire year, okay? And if we look at the days on market, by the way, it's 128 for the last month. Month before that, it's 61, still high. Then you have 83. It's essentially sitting at 80, 90 on average. Well, 3-month rolling average is 91, yeah? Okay, maybe the last month is an outlier, but if you look back at the trends, they're all sitting above the trend line at about 80, 90 days, you know? So you need increasing demand. Think about it this way. If property gets snapped up straight away, then the vendor controls the price.
Yep.
Yeah? So it becomes a seller's market, not a buyer's market. Now it's a buyer's market. I can negotiate the price down. Again, concern if I'm planning to, essentially generate equity. Now, Durack, on the other hand.
Yeah, okay. So with that market, that particular market, would that be suited to anyone? Or you think because the risks around longevity and then for long term and then days on market short term, that wouldn't suit anyone?
Yeah, so great question. Now, suitability of markets is based on comparison. It's based on brief and comparison.
True.
You do the brief and you have to do a comparison. Now, if I have 600K or 650, that's typical price for Humpty Doo, you need to see, are there any better suburbs for 650? So just going to Darwin because everyone else is going, it's disadvantaging you because there are, I guarantee you, better options for 650 that will give you more certainty when it comes to equity extraction and more certainty when it comes to long-term performance, okay? Yeah. So now, Humpty Doo is not a completely bad area, but why I say only a couple of suburbs are good in Darwin is because they're good because they are at the top, or at least one. They're at the top. When you compare it to anything else, they still sit at the top.
Okay.
Other than that, they're all sort of, at the bottom, relegated at the bottom, because when you compare it to other suburbs, there are much better opportunities.
Okay. So it's more so putting that in with the context with everything else that you're looking at. Correct. Rather than in isolation.
Correct. If you want, this is the thing, like if you want to eliminate opportunity cost, which is the cost of investing in a location that doesn't grow as much as others, you need to do a comparison. Yep. How else would you know? So I would put Humpty Doo on the shelf unless it is the only option that I have.
Yep. Humpty Dumpty on the wall. Yep.
Humpty Dumpty on the wall. That's it. Now, Durack is a little bit of a different story. Going back to the price, $591.
Okay. So Durack, this was the other option that appeared as well when we're sort of going through the filtering that always is there. So we'll dig into that a little bit more to see if that potentially has more exciting data points compared to Humpty Doo.
Yeah. So let's go first. I always say with analysis, start with the short-term timeframes and level 1 metrics. What are they? Supply and demand, okay? So if we go down, what do we see? We see also reducing supply, okay, long-term and short-term, so there's supply scarcity established, inventory the same, 0 building approvals, hold periods are close to 9. Perfect. Supply side is perfect. What do we see on the demand side? We see increasing short-term demand, but that increasing short-term demand is still sitting below the long-term trend.
Yep.
Okay, and it's sitting at a 54 days, 3-month rolling averages in comparison to 90. Okay.
Yep.
Now, let's say, there's a lot of people piling into, if there's a lot of people piling into Durack, people talk about data lags. Now, there's a data lag of a month. If I see a lot of people piling into a suburb, it will be reflected in a lower days on market in the next month's release. Mm-hmm. Yeah. So the lag is not real in the sense of how long the trends last in property investing. If I was investing in equities and, I'm talking about month, I can trade 15-minute charts, it's a problem.
Yeah, okay. Yeah.
So 54 days, what will this give you? If I look at this, what will this give you? Well, supply scarcity is severe, okay? Days on market being currently in 54 means it's in a neutral range.
What about vacancy rate as well?
Vacancy rate, sorry. So vacancy rate is sitting at 3.17. Okay, it's sort of increasing a little. And the issue with Durack as well is that you have a very high renter to owner population, 45%. Again, see, this is the thing. It is not perfect. But what I like about this area, and this is why I say this area would suit me personally, and we even might buy Durack, by the way.
There you go.
But it would be from 1 to 5 year timeframes. So after 5 years, and I'll tell you why. If I'm assessing this area, I'll tell you why I would reassess it at 5 years and potentially sell out. What I like about it is that the ERSAT score is 9 out of 10, wow. Extremely affluent, and look at the affordability. It's 21 years to own. This is virtually unheard of. So while the yields are high, meaning that it's,
talking?
well, 6% maybe, 6. High in the context of Australia wide, you know?
Okay.
So it's more affordable to buy, especially if you compound on top of that supply scarcity. Yes, the demand side of the equation is not perfect. It's not bad. It's neutral. It's not perfect. It's not sitting at a green 25 days on market like some Melbourne areas or whatever. But it's okay. I'll deal with that. I'll take that compromise because of all of these other factors. Now, why not long term? Well, if you look at Durack's typical price and this wiggly line here, it's been essentially flat from 2009 to 2022.
That's wild.
Now, if something is not performing for 4 years, it's fine. It's part of a market cycle narrative, okay?
Yeah.
Every market goes through cycle. But when it's flat for 2 decades, I'm concerned, okay?
Me too.
There is a reason for it. And now let's compound the decision making to see whether there's another affirmation there that would, be concerning for me or tell me not to invest in Durack for long term. Now, what is interesting about Durack's GRC again, only 81 months, better than Humpty Doo, by the way, only 81 months are spent in the positive growth zone. The lowest point of growth was minus 4.92 or 5%. So this area is not extremely volatile per se, but it's flat, as we saw in the typical price. So it doesn't reach enormous heights. It's not that it reaches enormous heights and then it sort of nosedives down. It just remains flat for long periods of time, okay? Which is why there's a very high level of affordability.
Yeah.
You know, the affordability index is sitting at 20 years time.
Yeah, in 15, 20 years, people's wages have went up.
Correct. People's wages have went up while the price was stagnating. That's why it's affordable.
But is there any indication to give you into the demand side that you're going to get any of that growth in this area?
You refer back to ranges, okay? Now, it's been days on market slope. If you look at it, it's been slightly nosediving long term, okay? And if I look at it across the entire time frame, it is essentially at the trend line, which is 54 days, 3-month rolling average. That's not bad. You know, it's not perfect, but it is not bad. But in combination with extreme supply scarcity, very high ERSAT and very high levels of affordability, it's a gamble I'm willing to make.
Okay.
Okay?
Okay.
Well, sorry, I wouldn't call it a gamble. It's an educated guess I'm willing to make. Okay?
Yep.
Now, another thing that I don't like about its long-term prospects is high rent-to-owner ratio. Why? I look at rent-to-owner ratio as a supply indicator. Okay? I don't look at it as livability, owner-occupier, this, that, no.
Okay.
I look at it as a supply indicator, especially now. We have macroeconomic conditions where interest rates are reducing.
Yep.
So for the next 4 years, we should see favorable interest rates environment. What happens after 4 years when interest rates start increasing and when all of those 45% of investors that are holding those assets find it hard to hold onto their property? Now, it depends where they bought and all of those other things, but the risks increase. Okay, we usually see when interest rates increase, they increase at a faster pace than rents. Okay, they always do. Okay, so the shortfall that people have to cover is much greater, which places the strain on investors, which could then lead to introduction of additional supply when the macroeconomic conditions are unfavorable. Yeah, which, if not met with the appropriate demand, especially now for 5 years, is sitting at 54 days average, is a concern. Okay, so for long term, there are, again, comparison, much better areas for long term within this price range. Okay, I wouldn't say much better because it's 550. You know, 550 is still, a low price point. There are better long term areas, but the fact that it's essentially top of the range when it comes to affluence, while extremely affordable, and these are the usual precursors for phenomenal growth. When you have high levels of socioeconomics and affordability, you usually see a pump, if I'm going to use a crypto term, if there is a supply scarcity established. So I'm okay with that. But guys, even going through this, we see that even Durack, the one that I really like, is not perfect. And I have to deal with it. And if you're investing in an area, assess its short-term, mid-term, and long-term potential. If you can generate substantial returns in the short period of time, you generate 70% in 4 years. Well, cop these sales and acquisition costs.
Yeah.
Sell off, get out, But you need to reassess it because not everything is great for long term. So that's essentially, Zucoli is another one which is next door. Okay, I think Zucoli came out of the list because one of the filters. I can't remember now whether it's supply side, but one of the filters is just a bit off.
If you go back to that filtering, can we go back to that filtering?
Yeah.
I just want to see one thing. Keep the other filters. Just change the data confidence from high to equals not low. Yeah, not low. Does that change our options there? I know there's a bit of...
There's only Howard Springs. I can't
Howard
remember.
Springs.
Yeah.
All right. What does that look like, just in terms of...
Okay, so let's do a quick health check. Okay,
Quick health check. Last one on Darwin.
Yeah, so data confidence is medium. Again, concerning because the metrics that we're looking at might change because of lack of volume of sales. Let's go to supply and demand first. What do we see? 99 days, 3-month rolling average for demand, very high.
Yeah.
Supply is reducing. Okay, building approvals. So essentially, supply side of the equation is Darwin is pretty good. Which again, that's at least good.
Whole period 11 years. Yeah.
Yeah. So it's nearly 12, 11.77. So supply side is good, but my concern is about the demand side. Now, when I say concern about the demand side, nothing is inherently good and bad. 99 days on market doesn't mean that it's bad. It just means that you can't expect 30% return in 3 years.
Mm.
You can't expect, if you want to, let's say this area stacks up when it comes to long term, you're not going to see any growth in the short term, but that's fine. If all the other indicators stack up, that's okay. But that's why you just need to set the expectation correctly. It's still affordable. ERSAT is high, decent, 8. It's interesting about Darwin is that, you have a lot of these areas that are coming up that have very, give you an example. Karoom Downs in Melbourne, which is essentially, again, pumping, and you get 20 offers for the same house, has an ERSAT of 3 for a typical price, don't quote me on it, but 750 to 800.
Interesting.
Yeah. And you see it now, again, on the flip side, Karoom Downs might have some restrictions or lack of steam at the 7-year mark when you're holding your asset into the future.
Okay.
Yeah. So for Darwin, it has a lot of room to move, but only certain areas because these ones, they will take long to generate. Essentially, for you to see a hotspot behavior, what's hotspot behavior? Simply you can look at Kerwin, for example.
Yeah. We've you called Kerwin last time you're on. Yeah.
Yeah, it was.
Or maybe the first time. Yeah.
Kerwin was. Yeah, I think it was a year and a half ago. I'm not sure when you spoke, but I just want to. Listeners can't actually see the screen, but I want to show you, and we'll talk to it. If you want hotspot behavior, see about the supply and demand trends.
Wow.
Look at how demand trend and sitting at 29 days, 3-month rolling average. Okay, so supply is severely reducing. Demand has been increasing substantially for long periods of time. Now, recently it's been weakening a little, but it's still sitting at 29 days, 3-month rolling average, which gives you this 30% return in the last year. So going back to Darwin, the demand side is not there yet for you to see these substantial returns,
Correct.
For Durack, I do think that you'll see great returns. Probably next year will be 10, then it will be 20, then it might be 30. And then at the 4 or 5 year mark, now, again, no perfection, no certainty, but I would still assess it at the 5 year mark and see how data is behaving to make a call.
Okay. Well, look, Matt, is there any other thoughts or comments on Darwin, or is that sort of Darwin in a nutshell, and who and what do you like in there?
Regretfully, it's in a nutshell. Essentially, there's not many suburbs to talk about.
Yep.
But I think I really want to urge people to. Obviously, there are degrees of preference or degrees of what's good and what's bad. Yep. People have probably bought in other areas and now they're thinking, did I make the wrong call? Well, just assess it and see what you can expect from this area. But just saying Darwin in general, it's great and all of those other things. And I'm the first one that supports it. Okay, I haven't initially, but then I sort of, went onto the bandwagon because I reassessed the data again. Just be careful and make sure you understand what will give you at certain timeframes and whether it matches your brief. That's all. That's the most important thing and crucial thing.
In comparison to, not in isolation.
In comparison to. Nothing in isolation has meaning. You have to compare it to other suburbs under the same price point and brief, yeah.
All right, well, Matty, I really appreciate the deep dive, mate. And for anyone that's listening to this or watching it, and we'll do a quick downloadable to maybe those top two. We'll put the suburb reports in the show notes if you want to have a look at them. And as always, we'll give you we'll put in the link to H-Tag if you want to be able to go through and find your own suburbs. Matty's a pioneer of this space, and I really appreciate your time to be able to go through. What's quote of the day? What are we saying, Matty?
All right, it's a tongue twister. Home is a place where all of your attempts to escape cease.
Okay.
It's a Japanese saying. I love that one.
Okay.
I actually started considering in the context of what's home, Australia or Serbia?
Oy.
So it might be Australia. I think it's Australia.
Dobro. Perfect. Done. Too easy.